So much for that, Vivek. But let's move on. And I actually managed to interact with JPMorgan's Pharma analyst, and this was on the sidelines of the 10th JPMorgan Annual India Conference. And we started by talking about, Trump, the threats that have come in terms of Pharma pack, what is going to be the tariff situation there. And Bansi Desai, Vice President at JPMorgan for India Healthcare as well as Pharma Research, spoke to us about these implications as well as a lot more on the pharma and healthcare space. Listen in to a slice of that conversation.
If you first look about the pharma space, most of the pharma companies have diversified businesses in India, right? About 1/3 of their revenues come from domestic market, which is the India branded generic market. That's something which is insulated. That's the market where you have structural and stable growth. About another 1/3 is where these companies generate revenue from the US market. Now, US is the market where, potential tariffs could have implications. Very difficult to predict policies, to be honest, but our sense is that most of these companies are going to adapt and manage the implications through combination of strategic and operational responses. Companies with higher exposure to US obviously, will be a lot more vulnerable than the ones who have lesser exposure. In our view, larger companies also probably will be better off in managing any potential disruption compared to smaller companies. A, because of the scale that they would have, and also B, because a lot of these leading pharma companies have manufacturing presence in the US. So maybe that can also help offset any of the potential tariff impact. But difficult to predict policy. If you look at US-EU deal, the pharma deal, generics are largely exempted. If you look at US-Japan deal, generics are largely exempted. So it remains to be seen whether Indian generics, will see tariff or not, and if yes, what would be the magnitude. But fundamentally, Indian companies do play an important role. We account for almost 45 to 50% of US generic drugs prescribed in the US. So we are a very important part of their supply chain. So yes, it remains to be seen.
Remains to be seen, but any concern also comes in for CDMO players. Will it mean that maybe CDMO players may not get that much of a business? Counting the downside risk, right? I'm just talking about the worst case scenario right now.
No, in fact, on the CDMO businesses, we believe they are a lot more insulated. The reason being the burden of tariffs actually lie on their clients and not on them directly. That's number one. The second is that if you look at the supplies of CDMO in terms of value terms, it hardly accounts for few percentage points of the large innovators' P&L. So even if tariffs were to be imposed, it's something that can be get absorbed by the innovators. So CDMO, in fact, I believe, in overall scheme of things, are relatively lot more resilient.
Bansi, let's talk about CDMO only, because I have heard CDMO since a year and a half. This is a space that's coming up a lot more, growing well. So in the CDMO space, every, I think, pharma company has some segment now that is CDMO, right? Where and what will we see the benefits coming in for CDMO players? Which players will see those benefits? Is everyone going to be benefiting? Is it the top line players who will benefit? Where?
So if you look at the CDMO industry versus a decade, we had only a handful of companies present in the space. Today we have a lot of companies present with bunch of capabilities within the CRDMO segment itself. If you look at the global CRDMO market, this is over $200 billion in size. And India accounts for only 4% share today. So we are very small, in terms of our size and scale. But we are gradually inching up in terms of our capabilities. We are also fast emerging as one of the preferred players or partners, by large innovators. And there are multiple reasons for that. Number A, if you see, we see structural macro tailwinds in this space, which is rising outsourcing penetration. The second is diversification strategy by large innovators, EU +1, China +1. On top of that, you have US-China tensions, all of which is driving higher business for Indian companies. The second is Indian companies also offer cost advantages. We have cost-efficient manufacturing, our compliance and regulatory track record is strong. We have large pool of scientific capabilities as well. In fact, on labor cost, we are comparable or even better, to Chinese counterparts. So we do offer, these inherent advantages. Last but not the least, if you hear the commentaries of these CDMO companies, all of these guys are talking about expanding aggressively. So they are incurring huge capex. Capex for this particular year is going to be almost 30% of their existing gross blocks. So that's huge, and that drives revenue visibility, right? The second is they are moving up on the value chain as well. Traditionally, we've been known for strong small molecules. Our capabilities have been proven on that side. But gradually, we see companies doing a lot more complex work like ADCs, which is advanced drug conjugates, oligonucleotide, peptides. Our capabilities are nascent here. We are not very big, but slowly and gradually, all of this is opening the target addressable market for Indian players. And we see this momentum reflected in companies' RFQ, which is request for quotation.
Yeah.
We see them announcing increased capex guidance.
Okay, so definitely a lot more interest coming into Indian CDMOs. That's the word coming in from JPMorgan there. We need to take a short break on that note, but we'll get you a lot more in terms of markets and stocks on the other side. Stay tuned.